So there's a scary statistic of seven-figure business owners in Australia that over 81% of them do not feel confident about investing in the share market, using that as a strategy to be able to create financial freedom. Now, after surveying thousands of business owners, going deep into their responses on our financial performance scorecard, and going through a deep case study with those who decided to become clients, and also those that didn't, we've been able to extract some really valuable insight that I think will change your relationship around how you look at the share market moving forwards. Now, if you haven't done the financial performance scorecard, I advocate you take 5 minutes, click the link below and complete it, and it'll give you a customized report so you can contextualize what we're talking about in this video. So let's talk about the share market. Now, what we realize is that for so many business owners, their preference for building wealth is through property. Me too, right? We believe that property is a fantastic way for you to be able to create a significant amount of wealth and compound that wealth very aggressively. But property is not the best way for you to fund your financial freedom. It just comes down to the numbers. When we look at a residential real estate portfolio, on average, most of them produce a gross rate of return of about 4%. You've got agents' fees, you've got strata, insurances, council rates, you've got maintenance costs, and then of course you've got the interest on the debt that you have to hold that particular property. Even if you pay off that debt, you'd be lucky to get a 2 to 3% income return on a residential asset, which is just not a great return on your capital. What it ultimately means is that you need to create 2 to potentially 3 times the amount of wealth than you have to create in other asset classes to produce the same amount of income. Now, when we work with our clients and we've helped them build out a $3 billion in combined wealth, a significant amount of that through the share market, there are some simple strategies that the most successful 7-figure and 8-figure business owners use when it comes to investing in the share market the right way. We call it the investment operating system. So the first fundamental principle around investing in the share market is a strategy that we call dollar cost averaging. Well, what does that mean? Let's put this into context. If you choose to buy an investment property, you need to settle that property all on one day. You're all in or you're all out, which then means that you have exposure for that entire asset from that particular day forward. Now, that could be a great thing, and for many people it is, right? You want to hold the whole asset, so if it goes up by 10%, you get a 10% increase on the whole asset. But it also goes the opposite way, okay? One of the benefits of the share market is that we have the ability to implement dollar cost averaging, which means we can drip feed money into the market and take advantage of the historical volatility that exists in the share market. One of the reasons why people love property is because it's stable. We're going to understand why it's stable. It's not being valued every 15 minutes of the day. Like even in a particular location, there might be, 10, 15, maybe 20 transactions that occur in any particular month. Whereas the share market, there are thousands upon thousands upon thousands of transactions that are happening every single minute. And for that reason, there is full transparency, which means we have clarity around the volatility of the market because of the reporting mechanisms. If property had the same clarity, the same transparency, the volatility would probably be pretty similar, okay? So with that volatility, the ups and downs of the market, we want to take advantage of. Why? Because we have the opportunity to buy potentially the same assets at a discount. Let me put this into perspective. Let's assume that you had the ability to go and buy a kilo of oranges for $2. If the next day the oranges drop to $1 a kilo, you can buy twice the amount of oranges for the same price. Now, I don't know what you're going to do with 3 kilos of oranges, but when we're building a share portfolio, the idea of incrementally accumulating those assets means that we can average the share price over time. So in other words, when the market falls, we have the ability to buy the market on sale. And using this dollar cost averaging strategy, we educate and condition our clients to build a positive relationship with market volatility. And we actually get them to a point where they actually get excited about markets falling. And they get excited about putting money into the market because the market's on sale. Pretty cool. Great mechanism for us to get the diversification and also minimize risk over time. Now next, asset class diversification. We've got to realize that there are multiple asset classes that exist. And in comparison, like residential real estate, you've got 500,000, 750, $1 million tied up in one asset in one location. That's a lot of money. Whereas with that same amount of money, we could potentially build a portfolio of 30, 50, 100, even thousands of companies, not just in Australia, but globally across the world. And when we build a share market strategy for our clients, we look at Australia, we look at US, we look at international, we look at emerging markets. We look at small companies and we look at all these various segments of the market that give us the opportunity to diversify our exposure. We know that all of those various asset classes not only do different things at different times, but they produce different results. For example, if we've got clients that are transitioning to retirement and need more passive income, we will focus on accumulating Australian blue chip shares. So we're talking big companies. Why? Because those big companies pay dividends, and those dividends come with franking credits. So in many cases, they might pay a 5 or a 6% dividend, but they've already paid 30% tax, which means we can now get an 8 or 9% pre-tax return. So if you are a retiree over the age of 60 and we've bought those shares in super, you can get a refund of all of that tax that's being paid. So in contrast, would you prefer to own a residential property that pays you 2%? Or would you prefer to own a portfolio of blue chip stocks that potentially pays you 8 or 9%? With the added benefit of no tenants, no strata, no insurance costs, and broader diversification. We don't have all of our eggs in one basket. It creates an incredible way to diversify. And the idea here, guys, is that we want to understand every single asset class has pros and cons. Our job is to understand those pros and cons and apply those pros and cons appropriately based on what you're trying to achieve. Okay. Next is super. What many people don't understand is that your super, more often than not, is broadly invested into the share market. So we want to consider, how do we utilize superannuation as a vehicle to get more exposure? Because super is the most tax effective way for you to fund your return. There is no other tax structure that exists in Australia that by the time you're 60, you pay zero tax on earning, you pay zero tax on any income that you draw out. We can hold exactly the same investment inside super and in your own name that produces the same return, but because of the tax differential, could have a 30 to 47% differential in actual net cash flow that you receive. Remember, super is just a structure for holding money. It's not an investment. We have the ability to choose the structure and we have the ability to choose the investment itself. So we need to consider, do we salary sacrifice? Do we have what's called concessional contributions to get more money into super? If we've got money that's lying around and we're getting closer to that age 60, do we make after-tax or non-concessional contributions to boost that up? There is also small business CGT concessions that we have access to that allow us to get a considerable amount of money into super that allows us to get that into a low or no tax environment, which is really, really cool. Now, it's important to distinguish that we can choose the investment strategy in super. So I see people naively saying, oh, how much does that super fund return? That's the wrong question. A super fund is just a tax structure. It's an administrator. It's there just to come up with the rules and enforce those rules. There are usually a plethora of underlying investments. And in many cases, business owners don't choose the investment. They just go with the default. And in many cases, those defaults are crap. They don't produce very good return. So it's important you get advice and that you play an active role in the investment strategy inside your super. And we see people sleep on this because they think like super's not their money. It doesn't really matter. And therefore, they don't play an active role. So for many of our clients, we design a fit-for-purpose, custom investment strategy inside their super. And for many of those clients, we even set up what's called a self-managed superannuation fund, which actually allows them to go and buy property using their super money. Really, really cool strategy. And we want to consider tax-effective investment strategies. So one of the things that most people don't understand is a concept called franking credits. So what is a franking credit? In Australia, we have a very, very lucrative tax system. Now, I know you probably don't want to believe me, but it's true. And what it means is that when a company pays tax on profits that are distributed, the tax that's paid gets transferred to the individual who's received that profit, and they can utilize that as a credit to offset any future tax. So one of the strategies that we use for many of our clients is that we set up a bucket company as part of their tax structure, which essentially is usually they've got a trading business. That trading business's shares are owned by their family trust, and that family trust has a bucket company that's attached. So we funnel excess profits into the bucket company, and then we invest in shares in that bucket company. We can also invest in property too. That company, bucket company, pays tax at 30%, and it accrues all of those franking credits. And then by the time our clients get to a point where they're sold the business, they're not earning active income anymore, they're getting completely passive, they usually have a lower tax rate than 30%. So then when we start distributing profits from that bucket company, we actually get them tax refunds for those taxes that are already paid. Really, really cool strategy. So it allows us to pay tax, but remember it. So then in future, we can use those tax credits when we're in a lower tax rate, or better, when we are in retirement, we invest in investments that give us franking credits. So then it allows us to gross up our returns and make more money, which is really, really cool. So the other big part here is capital gains tax, right? The goal here is we're investing in anything. We want to achieve two things. We want to create income. And for many of you guys, when you're in your accumulation phase, producing income is not a good thing. Why? Because you pay tax when you produce the income. Let's play this out, right? Let's assume that your business is already rewarding you substantially. It's more than what you need to live your lifestyle. So everything else that you receive is just surplus that you're going to invest. If your investments also produce more income, you're just going to pay tax on it and lose circa 30% or potentially more, then be left with 70%, potentially less, that you're just going to reinvest, which means that you have a minimum of 30% less money to reinvest in compound every year. Right? And we focus on buying investments that compound. You don't pay tax on unrealized gains, which means you can snowball 100% of those investments each and every single year. And then in the future, we can sell those assets, and then you get access to what's called the capital gains tax discount, depending on the structure that you use to buy those investments. So that means that we can reduce our potential tax to 24%, potentially less. So there's some really great strategies that we can implement. So we've got to realize shares. There are certain shares that don't perform well. There are certain people who've invested in shares and have lost money. And there are two reasons for that. One, they invested in the wrong companies that went broke and they didn't have the right diversification. Or two, probably more than likely, they couldn't manage their emotion. The market fell, they couldn't stick the course, they sold those investments, they crystallized the losses. This is an indicator of a lack of education and a lack of a financial strategy. So if you're a seven-figure business owner and you want to look at ways to diversify, if you want to learn how to invest in the share market properly, if you want to create a broad, diversified portfolio that allows you to create financial freedom and make sure that you're going towards that goal the right way, then the best place to start is the Financial Performance Scorecard. Click the link below, complete the Financial Performance Scorecard. It'll take you about 5 minutes. It'll give you a customized report across wealth strategy, tax strategy, and profit strategy, and it'll help you work out exactly where you need to focus your attention. Take 5 minutes, complete that scorecard, and let's work out where you need to focus your attention.